Hugh, welcome back. Good to see you, sir.
Yeah, nice to see you, Tyler.
Happy
Kelly.
New Year. Happy New Year.
Thank you.
Think that because of this sell-off, which has taken the S&P down, what is it, about 12% or so from its highs, not as far down now as it was at that low, that this is a good time to start picking up some bargains? We've gone from overvalued, in your view, to undervalued.
Yeah, the numbers, when you look at the numbers, when we started this whole process, it were about 4% overvalued. Then we got down very cheap, 12% undervalued. And now, of course, we've recovered some of that. And I think I would put it at about 4% upside potential between now. I mean, these are numbers that are, they'll change every day. But nevertheless, 4% upside between now and the end of 2022. Keep in mind, Tyler, Kelly, that this is a low return environment after the kinds of returns we've had in 2020 and 2021. So a low return environment, and when I say it's about 4% upside, that's not too bad, particularly if earnings, and I think this will happen, come in higher than we're currently forecasting or expecting. So it might even be more than 4%.
Is the major
opportunity?
Is the major risk to the market broadly a Fed error?
Yeah, it is. We take a look at history, and you see that continuously, you see that monetary policy has sometimes contributed to the end of the bull market and the start of a recession or the end of the current cycle. And, the Federal Reserve, if they do go through with their current sort of implied plans, which is 4, maybe 5 increases in interest rates this year, 4 in 2024, I think that raises real serious questions. And the questions really are we going to lead that to a bear market that's accompanied by a recession? As I crunch the numbers, we're clearly going to be looking at higher long-term rates. We're clearly going to be looking at a decline in price earnings ratios. And therefore, the upside potential for stocks is not going to be quite as attractive as we'd like it to be. But quite frankly, now that you're looking at 4% upside potential, it's not bad in a low return environment, at least in my judgment.
Hugh, what do you think the biggest mistake would be for investors to make right now?
I think the biggest mistake would be, Kelly, to quite frankly ignore what's going on in the financial markets. And what's going on in the financial markets is we not only saw in the month of January a decline and then some recovery, but you also saw somewhat of a fairly solid move towards defense. So you saw things in the sort of the sector end of things. You saw things like consumer staples and utilities at the top of the performance ladder. Now, technology was also up there, but nevertheless, at the top of the ladder, you saw defensive sectors. You saw value significantly outperform growth. And of course, that's changed a little bit more recently. And you see some signs coming from the credit markets as well, that investors essentially saw real problems ahead, real dangers ahead, and that's why they started to move towards defense. And I'm just simply suggesting that you don't ignore what you see from investors, because investors really tend to get it right just about every time.
You like Apple among the technology companies. I mean, that is kind of a staple holding, but you also like some of the consumer staples like Kraft and Procter & Gamble and others. Take us through that argument.
Yeah, that's a good point, Tyler. And the reason I do that is I talk about some of the so-called, let's call it bull market sectors, and technology would certainly be one. And Apple would be a good example of a technology stock that I think you can buy. That, again, is if there's a little bit of a shift towards growth, it's basically a balanced portfolio. But the reason I mentioned a couple of companies like Procter & Gamble and Kraft is because they're on the defensive side of things. That's responding to what I just finished talking about, which is sector performance with staples and utilities, but particularly staples being at the top of the performance ladder. They're very attractive for all sorts of reasons. The two most important reasons that I would mention right now is relative performance. I never like to catch a falling knife. I always look for companies that are posting relative performance or good relative performance versus the S&P 500. And that's true certainly of Procter & Gamble and Kraft. And it's nice to know that they've got a good dividend payouts or good dividend yields. And those good dividend yields will be fairly rewarding if indeed I'm wrong and this market continues to go down, or the Fed gets even more aggressive than I'm currently anticipating or forecasting.